What's up, y'all? So now I want to make a quick little simple video for you guys. This was actually a special request by one of the members, but I think this would be a good video to make for everyone. Not going to go into a ton of detail, but just going to kind of keep it very simple here. So just going to talk about the gamma levels here. So let's go over XOM here, right? So anytime you pull up these levels, you've got, you've got the zero gamma level, you've got the put wall, you've got the call wall, and then at the very top there, it has the stock price, right? And over here on the left, this is just the amount of gamma exposure, right? And then along the bottom, the x-axis, you have the price. And then these red and blue bars, these are gamma levels also. They represent calls and puts, right? So right below that zero gamma level, you see a big, huge red and blue bar. There's a high concentration of gamma at that level. That area tends to act as a magnet also. But what I want to highlight here on XOM and with the zero gamma, because the zero gamma level is a very important level, right? And when we cross below that level, we get what's called a gamma flip, okay? And when we go from above to below, we are flipping into a negative gamma environment, okay? And a lot of times what we see is gamma, or the price, will start to sell off and flush below that level. And it often kind of gravitates towards that put wall, which for XOM is at 105, okay? The reason behind that is the dealers and the market makers, when we flip to that negative gamma territory, they have to kind of move their positions around, and they're selling with the stock, or they're selling with the market, right? So as we go down, they're selling more because that's how they remain delta neutral, okay? And the reason behind this is, because other people are buying puts, they have to sell the puts, so they have to sell the stock or sell futures, whatever, in order to remain delta neutral, right? So as you can kind of deduce there, if they're selling while the stock is selling, that kind of creates this snowball exponential effect where we just kind of have a swift move down, right? And we will often see, like I said, sometimes a move all the way down to that put wall, right? And for this case, it's pretty far away. It's down at 105. So let's pull up a chart of XOM and let's see what happened, right? So this was yesterday, okay? And, XOM was already looking bearish, right? But so here's that 116 level, and we broke below that, and we traded all the way down to about 114.59, and then kind of bounced back up, and then that level became resistance from there, right? Sorry, that was actually 2 days ago. And then we gapped down below that and kept fading some more, right? So we opened at 114, and then we hit a low of 110, right? And today the selling continued, okay? So we ended up hitting a low of about 108.70-ish, 108.71, okay? So from 116 to almost 108, right? So an $8 move down in just a couple of days, right? So, a trade that you can take based off of that information is, once it breaks that level, you can add shorts to that position, right? So if you would have grabbed like a weekly 110 put, right, that probably would have went up, I don't even know, probably a couple 100%, right? Because it would have went from 5 to 6 points out of the money to now in the money by $1 to $2, okay? So most likely that's a 200+% gain. So the other thing you can do is you can grab like a put spread, right? So where the put wall is, it's at 105, and so you can grab like a 110 by 105 put spread, okay? And then, from there, once you get to the put wall, it's likely to kind of get slowed down there, right? That's kind of like a big wall that price tends to be supported by, okay? Let me go through another example here. So what I want to point out is below 0 gamma, the put wall tends to be a magnet, okay? And then, let me see. I need to find Tesla because I want to. Okay, here we go. So Tesla, the call wall was 260. Okay, you can see that over there. 0 gamma was 245, right? And Tesla was at about 257.53. And that call wall was still at 260. Even when Tesla was like down at 250. Okay, so a lot of times when we're above the 0 gamma level, that call wall tends to be a magnet. So you can kind of see what happened there. So once we were above that 0 gamma level, Tesla was just riding all the way up towards that 260 level, right? And you can see we've been kind of chopping around this 260 level since then, okay? So, this is a good play. Again, like you can just do regular calls, or you can do a call spread. You can do put credit spreads. You can leg into a butterfly. Like I could have done a 255 by 260 call spread. And then once it got to 260, I could have sold a 260 by 265 call credit spread, right? And just legged into a call butterfly. Because now we know that price is most likely going to chop around that 260 level until that gamma level changes, right? It's still kind of 260 right now. So, you can just kind of hold on to that fly. And, at that point, you're probably riding it risk-free, right? So you can take off, half of the call debit spreads that you initially grab and then have the call credit spread and just hang on to it and try to ride out the chop. And hopefully you can hit like a 500% plus trade. And just quick reason why we tend to gravitate or chop around that 260 level is as we go above the 260 level, market makers are going to be selling the stock because they're holding calls, right? So as the stock moves up, their calls are gaining delta, so they have to sell stock in order to reduce their delta exposure, right? And then against or below that level, they're buying it back, right? So as you can see, and these are market makers and dealers, they have tons of liquidity, right? So, you have that much money, you can really control the price movement of the stock, right? So above 260, they're going to be selling the shares. Below 260, they're going to be buying them, right? So that's what kind of keeps price pinned to that 260 level until something fundamentally changes, whether it be, news that causes, algo levels or a big order of aggressive buyers or aggressive sellers, or a bunch of people buying different options that will change that gamma level, and then market makers have to adjust that position. So just want to quickly go over that one. And then Triple Q, I wanted to go over this one just as an extra example. So I posted Triple Q this morning. So you can see 359 was the 0 gamma level there. Put wall was 350. And Ketz did post about a big gamma level at 355, which we did hit. So you can see early this morning, and I posted that it broke, and to watch 359, we broke below 359 right here, okay? And we just started selling off for the rest of the morning until about 355, right? Which is that major GEX level that Ketz had posted about, okay? So, that's just another example of how you can use these gamma levels. I'm trying to see if there's anything else I want to go over. So there hasn't, let me see. Actually, So the other way you can use these GEX levels or gamma levels is 325. That's 10.3. Okay. Yeah. So the other way you can use these is basically you can fade moves above the call wall or moves below the put wall. Okay. So here, the put wall at the time was 425. Okay. So if I just pull up the SPY chart, so here the put wall was at 425, right, which is up here. Okay, so you see SPY went from 420 and came back up to 425. Okay, so and this doesn't work all the time, right? So don't load up your entire portfolio on these positions, but it's something that can help with your trading decisions, I think. But anytime I've just noticed that when we're below the put wall, we tend to gravitate back up at least to the put wall or even above it, okay? Unless, again, like something is going on where aggressive sellers are just continuing to pile in because of some news, or people keep buying puts for whatever reason, and then the market makers have to keep selling and selling and selling and selling, and then most likely that put wall is then moving down, right? So you have to check it a couple of times to make sure it's not moving down. But and the reason I think that happens is basically once we get so far below the put wall, people that have puts that are deep in the money, they're going to start selling them because they're happy with their profits. If they're up 100+%, they're going to start closing those things out, right? And if they're done, then market makers are going to be buying back their shares that you're short, and then that's going to drive the price back up. Okay, unless people keep if they keep rinsing and repeating, and then they buy back, they sell their puts for profit and then they roll them down to a lower strike, then yeah, we're going to keep rolling lower, right? And then you have to watch that put wall to see if it's moving lower with the stock as well. So, again, just something I wanted to kind of go over, just like a brief, simple breakdown of how to use the gamma levels in your trading decisions. I hope it helped. If you guys have any questions, just let me know in the Discord, and I'd be happy to answer them for you. All right, thanks, guys. Have